Good afternoon, everyone. Thanks for joining us today on this State of the Economy webinar being presented by longtime PPFA member, board member, and officer, Dale Stroud, where we feel very, very fortunate to have Dale presenting today and look forward to it. Dale, with that, I'm going to pass it on to you.
Thank you, Jeff. Good morning or good afternoon or just straight good noon to my former colleagues and friends at PPFA. Even though it's a virtual way to meet and talk to you again, it's good to be back. It's the biggest change since I last saw you is we moved from Minnesota to North Carolina, so things have changed a bit for me. But without any further ado, let's get started. We've got quite a bit of ground to cover. First thing I'd like to say, there's a little bit of a caveat here in that anytime you're talking about the economy and that what might happen in the economy is we have to assume that vaccines that have been developed actually work, that will help the distribution issues and the inoculation issues, and that people actually take it, it works, which I actually saw a survey yesterday issued by the Census Bureau and the CDC. 51% of adults who haven't taken the vaccine say they will definitely take it. 26% said they will probably take it. 14% say they will probably not. And 10% said they will definitely not. So I guess I would say wear your mask, but hope people do take the vaccine so we can get this behind us. And so therefore, what I'm saying is that we have to assume that we get past this pandemic for all these economic forecasts to hopefully come true. Next thing I need to remind you is I don't belong in this picture. I am not an economist and don't pretend to be one. What I do is I take information from different economists, not necessarily the ones pictured here, and try to understand it and distill it and share it and make it so that it's understandable to the layperson. So I view this as a layperson's way of presenting information from professional economists. Now, fortunately for you, the membership of PPFA, you're going to have a real economist at your virtual meeting coming up in a few weeks. So hopefully he can give you a little bit of a different flavor that brings some professional economic input into it. I'll do the best I can from my perspective. What we're going to do today is cover this in three general categories. First, the general economy. Secondly, residential construction, and then lastly, non-residential building construction. So let's first, as I said, we'll get into the general economy. And since we span 4 time zones with the people on this presentation and listening to this presentation, it's lunchtime for some of you, so I'm going to serve some alphabet soup. Specifically, we've only got 7 letters in our alphabet soup, or 5 letters, I'm sorry, in alphabet soup. V, W, U, K, and L. I guess we'll call it. And we also have one symbol, and that's the, we're going to modify these letters slightly. Take a little bit off the K and slant the L. And what this represents is the shape of economic trends in this country. For example, V shape is where we went down rather rapidly, up economically rather rapidly, it's a V shape. If you have a double dip recession, it's a W. A U means you go down, stay down for a while, come back up. A K means you go 2 ways. Part of the economy goes up, part of it goes down. And an L means it's a fairly and a slow recovery. And let's add one more thing to this, and that's the Nike swoosh, another shape that could represent where the economy is going. So we'll go through, as we go through the presentation, look at some examples of the on the economy. Let's cover first GDP, gross domestic product, some stocks and bonds. This graph shows the percent change in the US GDP, real GDP, quarter by quarter since the beginning of 2011. And as you can see, the change typically positive, except for 2 quarters in that time until recently. Change would typically be a couple percent on a quarter-over-quarter basis. And then the pandemic hits, and look what happens. We go down 5% in the first quarter of 2020, 30% in the second quarter, and then dramatically up 34% in the third quarter. Those were the two largest swings in the history, the largest decline and the largest increase since GDP started being tracked in 1947. So dramatic changes. The 5% there that I show for fourth quarter of 2020 is kind of a consensus. It's kind of over the board right now. The actual number won't be published for a while yet. For example, the Federal Reserve Bank of Atlanta thinks it'll be 11.2%. Most other experts, those economists I talked about earlier, are more in the 3, 4, 5% range. So I chose to use 5% as the representation of the GDP growth in the fourth quarter of 2020. But the key takeaway is look at those swings caused by COVID, just dramatic decrease and increase. This graph shows GDP on an annual basis, the change on the bars to the left axis, absolute amount of GDP in trillions of dollars on the blue line to the right axis. Bank of Philadelphia as the source for they did of what the economy actually 20 and what it's likely to do in 21 and 22. And that survey showed decline in 2020 and an increase of 4% in 2021 and a 3% increase in 2022. If that actually happens, this is what happens to the actual GDP. Just about recovers back to the 2019 level in 2022. So I'm going to give that an L. Just for the sake of comparison, for those of you that have operations in Canada or live in Canada, this is the Canadian GDP from 2015 by quarter till recently. And similar to the US, but smaller magnitude, about a 10% decline in the second quarter and about a 10% increase in the third quarter. Fourth quarter numbers haven't come out yet. So Canadian situation was similar, but to a less magnitude than the US. Something that probably any of you who own stock, which most of you do, you probably follow, is what's going on with the stock. Two graphs here. The one on the left is the Dow Jones Industrial Average for the last 10 years, and the one on the right is for the last 100 years. If we looked at the left side for a second, I outlined what's been called the Great Recession, which is ultimate oxymoron, Great Recession. The Great Recession of 2007 through 2009 is the gray, and on the right side there in yellow is the current recession. By the way, there's a group called the National Research Economic Board that classifies when the country actually goes in and out of recessions. And that board determined in June of 2020 that we entered a recession in February of 2020, but they have not yet determined whether we're still in or not in that recession. A lot of economists, and you may hear this from the Wells Fargo economist, when you hear him in a few weeks, he may say we're already out of it, but it hasn't been officially ruled whether we are in or out of the economy. And imagine if you ask those unemployed people today, they were saying we are not out. But let's highlight just what's going on since COVID. And this shows what happened to the DJIA, the tremendous or significant drop, I'm called tremendous, a significant drop during the height of the COVID, and then fairly steady increase, and we'll give that a swoop. So the stock market has been significantly resilient during this very trying times. If you look at the right graph, again, that's a 100-year history. The interesting thing there is we just had the longest duration or gap between recessions. Those, I don't know if you can see them on your screen, the gray vertical bars. 128 months between the end of the Great Depression, the end of the oxymoron recession, current recession, 128 months. Because frankly, what that suggests is we were probably, just from a historical standpoint, probably due for a recession, regardless of whether COVID triggered it or not. the economy just basically runs out of steam after a while. So COVID probably triggered the start, but it was likely to start no matter whether we had COVID or not. Employment, one of the most significant things to think about and talk about and figure out during this recession is what is going on with employment. This graph shows cumulative change in non-farm job creation starting in January of 2004. And by the way, when you listen to the business news or read the paper or the internet, when they talk about how many jobs were created or lost in the prior month, they're referring to non-farm jobs. That's what counted in most of the data that's collected. So the way you read this, back in January of 2004, there were 130.6 million non-farm jobs. Then that grew. We added roughly another 8 million jobs to that until it peaked out at the end of 2007 when the Great Recession started. And we promptly lost 8 million jobs plus another million jobs, and it bottomed out there in early 2010. Then things started to improve, and we added jobs for a long duration of period of time. In fact, there were 113 consecutive months of job growth after that little blip there in 2010, to the point that we had 152.5 million non-farm jobs in February of 2020. Then the COVID pandemic started, and we lost over 20 million jobs, 22.2 million jobs in 2 months, and bottomed out at 130.3 million non-farm jobs in April, and then started building back, where in December, there were 142.6 million non-farm jobs. So we're well on our way back. However, if you look at the peak between 152.5 and 142.6, where we are today, there's still 9.9 million people unemployed due to COVID. And 37% of those, roughly 4 million of those people, are in long-term unemployment, which means they've been unemployed for more than 27 weeks. So a lot of hardship for a lot of people. One thing that's a little disconcerting, if you look at the very tail end of the December number, we hope we're not at the beginnings of a W. There was a downturn in December in jobs. There was actually a loss of jobs in December. Is that a beginning of a W? We don't know. Actually, the expert forecast is that we will gain somewhere between 4 and 5 million jobs this year. So hopefully the December downturn was an anomaly and not the start of a W. There is one real significant concern about the job market, though, and that is what we call the bifurcation of jobs. What this plot shows, and this is from tracktherecovery.org, is that if you look at the percent change in employment from January 20th till the current time, there's actually been an increase in high wage employment, which is classified at $6,000 a year, but yet a 25% decline in jobs for people in the lower wage. So what we've seen is higher wage people have not been anywhere near as affected by the employment situation as the lower wage people. You know, what we're seeing is people in the restaurant industry and hotel industry and the bar industry and so forth have really suffered through this. So we're seeing part of the employment situation has improved at the higher income, and part of it is really still very much depressed. A situation that has to be resolved before we can get true economic improvement. Going back to the slide I had on there a second ago, this still shows the non-farm jobs in green, and then the construction industry in yellow or gold, depending on how it shows up on your screen. You see there, the construction industry is almost back up to where it was prior to the downturn due to COVID, 7.41 million jobs versus 7.4 in February. So the construction industry is recovering. I don't know about you, but I can only look at graphs and charts so long before I have to do something else. So let's take just a couple seconds to talk about some construction trivia, since that's kind of the lifeblood of your industry. So the first one is, This famous photograph was taken in 1932 during the construction of what building? Here's a hint. That's the cast of Rock 30 Rock, I should say. So that was Rockefeller Center where that photo was taken. In case you haven't seen it, here's an updated version of that photo that was just updated last week or 2 weeks ago. Our next trivia: of the 25 tallest buildings in the world, how many are located in the United States? The answer is 3. One World Trade Center, Central Park Tower, which is a very new building, and Willis Tower, the former Sears Tower in Chicago. However, you go out to 2025, only 2 of those buildings will be in the top 25. One World Trade Center will drop down to 8. Central Park Tower will drop down to 19, and Willis Tower will disappear. By the way, the tallest building in the world right now is Burj Khalifa in Dubai, which is 2,717 feet tall. But under construction to be done by 2025 is the Jeddah Tower in Saudi Arabia, which will be the first building to top 3,000 feet. It'll be 3,281 feet tall. Okay, back to graphs. This is the same graph again with construction and non-farm, but I've added 3 other industries that have been affected by COVID more than some of the other industry sectors, and that's travel and leisure, retail, and manufacturing. So you can see travel and leisure in the pink line, I hope it's pink on your screen, was doing quite well prior to COVID and then absolutely cratered during COVID, as you might expect, as restaurants, bars, hotels, and so forth suffered greatly. And then you can also see the same pattern for retail and manufacturing. One thing appears to be definite, I'll just screw that up, pretty definite here is that travel and leisure is taking a recovery in the shape of a W. It went way down, up, now on the downward track again as parts of the country have sort of shut down again during the resurgence of the COVID. So hopefully it does recover again in time. If you have any friends, relatives, neighbors in the travel and leisure industry, they can certainly speak to this firsthand. Another way to look at that same data is on this bar chart. The red ones, the 100% would be representative of the level of employment in these segments in February, pre-COVID. There's the number of people in those segments. See, non-farm, in the peak of the pandemic, it dropped down to about 85% of the previous level and climbed back to 94. You see the number for construction. Travel and leisure, almost 50% of the employees in the travel and leisure industry lost their jobs. It's back up to only 25% lost. Still out of work. It's an improving situation, but a long ways to go. One of the key things that people are discussing and trying to consider is how long is it going to take to get back to the pre-recession employment levels? What this graph shows in 1990, the recession that started in 1990, the one that started in 2001, that started in 2007, are the red, orange, and yellow lines respectively. I suppose you can hear my dog. And how many months it took for the economy to get back to the pre-recession employment levels. So you can see the 2007, the Great Recession oxymoron, took over 6 years to get back to pre-recession levels. The green line on the left side there shows what's going on with recovery during the current recession. And as I mentioned earlier, the expert opinion at the moment is that we'll add about 4 to 5 million jobs back to the economy this year, which is where I put that green dot right there. And if it continues at that trajectory, we'd be back to 100% in a little over 2 years. Unfortunately, that's not the trajectory that it's taking as of now. That's the trajectory it's taking right now, which means it will take over 4 years to get back to the pre-COVID level. So let's hope that the expert predictions are correct and the trend is not. This slide illustrates why that trend is occurring. What this slide shows is the average change in not the average, the actual change in non-farm employment from January 19th until December of 2020. As you can see, the average change was a couple 100,000 up until the pandemic hit, and then 1.4 million jobs were lost in March and another 20.8 million lost in April of last year. So 22 million people lost their jobs in that 2-month period. And then recovery started occurring pretty good in March, June, July, perhaps August, added back quite a few jobs. But then since then, the rate of change of jobs, the increase in jobs has diminished. And in fact, in December, 140,000 jobs were lost. So the reason that slope on the previous graph was extended out is because the rate of change in terms of recreation of jobs has slowed more than sped up. So we have to hope that an increase is indeed ahead of us and we do get back to a good rate of job change. So let's look at unemployment for a second. This is a graph of the national unemployment rate starting in 2004. As you might expect, it went up during the Great Recession and then slowly came back down and got down to actually a fairly low level. That's back when those of you who had hiring responsibilities had trouble finding employees in 2017, 2018, 2019. The rate of unemployment was so low. You see the long-term average there is 5.8%. Then, again, as you would expect, unemployment rate peaked during the March-April period and got up to about 14.7%. Is now come back down in December to 6.7%. However, there is a caveat here, and that is over 4 million people have dropped out of the job market. People that would otherwise be employed have decided they don't want to be employed right now. They have to stay home and take care of their kids or teach school to their kids, or just don't want to be out in this environment with the COVID going on. So they're not being counted as being unemployed. The unemployment rate only counts those people that are actively looking for work. So the actual unemployment rate, if you add those 4 million people back in and voluntarily and presumably temporarily dropped out, would actually be higher than 6.7%. If the projections on employment, however, are correct, we don't know, 2020 numbers will be released soon, but probably about 8.2% average for the year. 2021, the average should be about 6.3% if the projections are correct, and then dropping down to 5.2% in 2022, which is, again, below the long-term average. This then is actually, the green line is the same data on the previous slide, except it looks different because I had to expand the scale to be able to get the construction industry onto the same graph. So the construction industry unemployment rate, as you can see, is typically higher during and after the recession of 2007, 2009 was extremely high. And it bounces around up just above the unemployment rate for the non-farm employees as a whole. As you can see, recently it did go up quite high during the peak of the pandemic and has increased again recently, which is fairly typical that the unemployment rate in the construction industry does increase during the winter months. So this is how the construction industry, which you're all very dependent on, how the unemployment rate there compares to the overall unemployment rate. Again, for comparison purposes, the Canadian unemployment rate is shown here. As you might expect, it peaked at around 14%, it's dropped back down to 8%. And there's the long-term average of 6.2%. So a very similar situation in Canada and the United States. One thing that has really been a problem is the unemployment insurance claims. What this graph shows is on a weekly basis, how many people have applied for unemployment insurance. As you can see, it was fairly flat, 100,000 a week up through the start of the pandemic, and then start the week ending March 21st over 3 million people applied for unemployment insurance. The following week, 7 million people applied. And since then, it's come down, but we're still having around 900,000 people a week apply for unemployment insurance. So that is a situation that has to improve before the economy as a whole can really get tracking again. So what we had hoped for was an inverted V, that the unemployment claims would come back down rather quickly. Instead, we're getting is half of a U, and hopefully that's only half of a U and it doesn't go back up again. But look at it is the cumulative number of unemployment claims that have been filed since the start of the pandemic. That equals 76.5 million applications. And that represents 50.2% of the number of people that were employed prior to the pandemic. That's not to say that 50% of the people are out of work, because some people have had to apply more than once. They lost their job, applied for insurance, got another job or regained their job, lost it, applied again. So it's not necessarily, 38 million people haven't applied for unemployment insurance, but 76.5 million applications altogether, including some repetitive applications. Again, something that is an extreme drag on the economy right now. Let's look at customer attitudes. There's two groups that try to survey this each month. One is the Conference Board, which is a nonprofit group. Actually, a lot of corporations can belong to it. Some of your companies may. And then there's the University of Michigan. I'm an Ohio State fan, so it hurts me to say that word, but the University of Michigan and the Conference Board each month measure consumer sentiment. The Conference Board calls theirs the Consumer Confidence Index, and Michigan calls it the Index of Consumer Sentiment. And this shows both the Consumer Confidence Index and in blue and the Consumer Sentiment in orange. And the yellow dotted line across there at 100 is kind of the demarcation between optimism and pessimism. So you can see during the 2007-2009 recession, quite pessimistic. It took us a long time to get optimistic again. We were getting pretty optimistic as a society before the pandemic, and then whoops, we got pretty glum here for a while. Things have improved a little bit, but we're still just not really confident in the future. And I should point out that the confidence index tends to measure how we're feeling about things that are going to happen down the road a little. Like, for example, will I have a job in 6 months? Whereas the index of consumer sentiment is more current, like what is the price of gasoline today? So there's a little bit of difference in the way these two surveys look at things. Both are saying that the confidence of us as the consumer public, we're a little shaken at the moment, as to be expected. And the reason that's important is this is a graph of personal consumption expenditures. And personal consumption expenditures account for 70% of economic growth. So if we're not confident in what's going on, we're not going to spend as much money, and personal consumption will be hurt. As you can see, during the pandemic, about $3 trillion of consumer expenditures on an annualized rate were not taking place. That's since recovered, but we're still not back to the historical rate of personal consumption expenditures. So that's a critical aspect. We've got to get this pandemic under control to get personal consumption back where it needs to be. We have got to be able to get out of our houses and spend some money and have fun again. It's not the Statue of Liberty, believe it or not. The official name is Liberty Enlightening the World. If you've been to San Francisco, you probably know the answer to this. And therefore, you know it's not really gold, it's orange. So let's look at economic indices. What these do are indices that kind of predict what may happen or is happening. The Conference Board, that same organization that I said does the Consumer Confidence Index, each month formulates what they call the leading economic index and the coincident economic index. So the leading index, the blue line, is predicting what will happen. The red line shows what is happening. As you can see on the right side there, it shows what elements make up those indices. If you look back to the recession started in 2001 and the one that started in 2007, the leading index, as might be expected, since it was predicting what's going to happen, recession started shortly thereafter. If you look at the current recession, it looks like the leading index was actually about to drop just before the pandemic hit, and then certainly it did drop. Since then, there's been reasonably good recovery in both the LEI and the CEI, although they're tapering off a little bit. It's encouraging that these indices are picking up and showing better times are ahead. A group called the Institute for Supply Management, a very large group, some of your supply chain people may belong to it, each month does a survey and says what's going on in the manufacturing industry. An index of above 50 says that there's growth in the manufacturing sector, and an index below 50 says it's contracting. And indeed, we were doing quite well prior to the pandemic, although things had begun to decline before the pandemic. And then things really crashed during the pandemic, but now pretty good recovery since then. And that once again, the manufacturing sector is growing. And this is an index that is actually closely followed by the investment community. You'll see dips and peaks in the stock market in particular after the manufacturing index is released each month. The same organization also does a services or non-manufacturing index. Again, a similar pattern. It was declined during the initiation of the pandemic and has since recovered. So the manufacturing, the service sector, is also growing. Okay, let's get into construction itself, not leave the general economy behind us. The Census Bureau publishes what they call the private construction put in place. And they have not yet done the 2020 final. So 2019, they said private construction put in place was about $1 trillion in 2019. And fairly evenly split between residential and non-residential, a little bit favoring residential. Again, this is private only. If you were to add government spending, then the non-residential sector becomes a larger percentage because of bridges and roads and airports and that sort of thing. But if you look just at private, it's roughly a 50-50 split of $1 trillion. So let's start by looking at residential. Each month, in fact, just last Thursday was the most recent, each month the Census Bureau publishes a report that has the number of eyes for residential. It's granted, but not yet stick construction that started, those houses that are under construction, and those that are completed. But the ones that have the most pertinence for your business is probably start, because it's not until a house is started that they're going to need your product. So we're going to spend most of our time in this section talking about construction, residential construction starts. This is a graph of construction of residential starts since the Census Bureau began keeping track in 1959. It's interesting to note that housing starts are not dependent on, or vice versa, they're independent of population. The population in 1959 of this country is about 180 million. Today it's almost 340 million. Construction starts really don't change. They're cyclical, but not dependent on absolute population. They're dependent on change in population, but not the absolute population. That's the construction housing bubble that happened that we all remember all too well. Just prior to the recession of 2007, we were building way too many houses that weren't needed. So what happened is the housing industry, we lost 73% of housing starts in a matter of 4 years and bottomed out just a little under 600,000 starts from year from a peak of almost 2.2, over 2 million starts. As you can see, we've slowly climbed back since then. Last year, there were 1.38 million housing starts, which represents, since that Great Recession, that oxymoron, we've had 11 consecutive years of consecutive growth since the end of that recession. So let's give that an L. One thing I need to explain before we go any further is what SAR is, S-A-A-R, seasonally adjusted annualized rate. If we look at actual housing starts for the months of January 2020 and July 2020, there are 113,100 actual starts in January of 2020 and 138,700 actual starts in July of 2020. If you annualize those starts, in other words, multiply them by 12, so if you construct houses at that same rate for the entire year, the January would have annualized at 1,357,200 starts, and the July number would have annualized at 1.6644 million starts. That's not the number the Census Bureau reports, because they do a seasonal adjustment. So the number that the Census Department reported for July and January, respectively, 1.17 for January and 1.487 for July. The assumption is that during the cold months, November, December, January, February, starts, there may be demand for new homes to get started, but they just simply can't be started because of climate and frozen ground, and the holidays kind of get in the way too. Whereas in July, what's happening is starts that may have taken place during the cold months are taking place in the warmer months, so they're kind of borrowing. So the actual number of seasonally adjusted starts is lower. So you boost the number of starts in the cold months, in the winter months, and depress them from a reporting standpoint in the warmer months. So let's go to a graph that shows SAR starts starting in 1959 up through middle of or the end of January or end of 2007. And the reason this is interesting, this replicates a graph that shown at a PPFA meeting by an economist in the fall meeting of 2007. I don't recall where we were, but it was obviously near a good goal. But what the economist said, it was, you can see, the housing starts were pretty much in a free fall at that point in time. And what that economist said, he said, don't worry, because housing starts never really drop below 900,000. You look at it on a SAR monthly basis. 900,000 is pretty much the lower threshold. Yeah, there's a couple months where it drops low, but 900 is a pretty good lower level. And also, when there is a drop in housing starts, the recovery forms a V, a mirror image of the drop. So if that's the case, if housing starts never really drop below 900,000 on a monthly SAR basis, and if the recovery is V-shaped, this is more or less what should have happened. Should have dropped down to 900,000, come back in a V recovery, and then continued on from there. Well, as you may guess where I'm leading to, that's not what happened. This is what actually happened. It was a much steeper drop down to about 500,000 on a monthly basis, on a SAR basis, with a very long protracted recovery. Now, one thing that is correct is that during the current downturn, housing did drop the bottom line. Starts did bottom out at 900,000, and it had a V-shaped recovery. Now, I'm not saying anything about that economist. I'm just saying it's a very, very tricky situation to understand exactly how the housing starts are going to occur in when you're in a very dynamic and a changing environment. So forecasting housing starts can be a bit of a dilemma. To give a different perspective, these are housing starts on a monthly basis instead of going back to 1959. This is just for the last 3 years for housing starts. So it's been trending by the yellow line that's been trending slowly upward. Last month, we had 1.669 million housing starts, which is actually the highest it's been since September 2006. If you look at it on an individual, single, and multifamily basis, this is single family starts trending upward fairly well over the last 3 years. And this is multifamily, which has been much flat in the last years. Most of the recent growth in housing starts is in the single family sector, which single family buildings take more plastic pipe than multifamily. So I guess that's the thing. A little different way to look at it is the relative amount of single family and multifamily starts. Prior to the recession of 2007, 2009, single-family starts were averaging about 80% of total starts each year. And kind of a step change since then. It's closer to 70% of total starts, whereas it inch up a little bit again because of the fact that more recently single-family starts have been growing faster than multifamily. 70% seems to be a fairly consistent number now in terms of the percentage of starts that are single-family. £120,000 without the foundation. 141 million condos, houses, and apartments, of which about 1/3 are more than 50 years old, and about 2/3 are more than 30 years old, which implies, and actually indeed, the remodeling market, the residential remodeling market, is very strong at the moment. When you've got about 70 million homes that are more than 50 years old, and about 85 million homes more than 30 years old, a lot of houses are in need of remodeling, which we're remodeling our kitchen right now, and it's a tough market right now. There's so much demand. You can't get appliances, you can't get contractors. It's an interesting phenomenon right now. Another quick way to look at things is, how did 2020 compare with the 3 prior years as the years unfolded? As you can see by the green line, 2020 started out pretty strong, and then the pandemic hit and things got a little bit slow and then accelerated pretty rapidly as the green line moved considerably above the 2019 yellow line, to the point we wound up 7% growth in total housing starts from 2019 to 2020. Up until now, we've been talking about starts. Permits is another important thing, because you're not going to start a house unless you have a permit. So permits have to be accelerating or holding up in order for starts to hold up. And indeed, as you can see by the orange line, permits are going up at a pretty high level and on an upward track. And over 99% of localities in the United States, there's some that don't, but about 99% or more require permits. So a high level of permits is a good indicator that starts should continue at a good level. A group called Vonda, Myers Research, tracks what they call new home pending sales. So the houses aren't yet sold, these new houses, but they're pending for sale. And again, that's been on a significant upward, tailed off the last couple of months. Pending sales are doing quite well. So you go from the start to the completion to the pending sale and then to the actual sale. So the Census Bureau tracks actual sales. So these are actual sales of the last 3 years. You can see they've been trending up. They've been down a little bit the last couple of months, but overall they're trending up. So both pending sales on the previous graph and actual sales on this graph show that we're doing pretty well. Another thing to look at is the months of inventory of unsold homes. That's the blue line. 6 months of unsold inventory is about where you want to be. It's considered in balance. You've got about 6 months, you've got about the right number of homes that are available for sale, new homes that are available for sale. If you have more than 6 months, you've got a surplus. If you've got less than 6 months, you've got a shortage. Right now, at least on a national basis, we've got a shortage. There are some areas of the country that's worse than others, but a low inventory of homes, of unsold new homes, means we have to build more to meet demand. Each month, Wells Fargo and National Association of Home Builders cooperate to develop what they call the Housing Market Index, the HMI. Essentially, a measurement of builder optimism. And that's the orange line, which goes to the right axis. The green line is single family starts, which goes to the left axis. As you can see, the builders they were pretty optimistic prior to the COVID recession, got pretty pessimistic for a while as the orange line dipped. And then their optimism has increased back to a pretty high level the last couple of months. So home builders are pretty optimistic about what may happen. What are the primary drivers of new home construction? Actually, there's three primary ones. Household formations, that's different than marriages and different than families. It's when people strike out on their own to form a household. It could be a marriage, but it could also be someone graduating from high school or college or leaving the service or a divorce. There's various reasons households can be formed. Demolitions is another factor. There's due to fire, earthquake, tornado, flood, and some intentional demolitions occur, so those have to be replaced, and then there's second home building. Together, those factors say we should be building about 1.4 million new homes every year. If you go back to one of the slides I showed earlier, we have not built 1.4 million houses in this country since 2006. So indeed, we're way behind on building houses. There's pent-up demand for new houses. So that's depends on what angle you want to take on. It's either encouraging or discouraging, but it means we have to build more houses to keep up with demand. So we go back and do a quick review for housing. Demand is high, permits are up, pending sales are good, final sales are high, inventory of unsold homes is low, so we need more. Builder optimism is high, graphics are favorable. Didn't talk about this, but mortgage rates are low. And buyers want new home features. A lot of things we've learned during this work from home phase is we want different types of houses. So what do all those pluses equal? It says the answer is we're going to have growth in the new housing market in 2001 and 2022. I'll say this right yet. 2021 and 2022. Not explosive growth, be moderate growth, because there are a few things that are of concern. There's some signs that the surge from new buyers is waning a little bit. We showed it earlier. New sales have off just a bit. Affordability is getting to be an issue. It looks like there's going to be an uptick. Mortgage rates still quite low, but an uptick. And there are some uncertainties, obviously, where people will have jobs or what the concerns they may have, why they might hold up and buy a home. Then from a builder standpoint, they've got some concerns. There's scarcity of developed land. Cost of materials is going up, especially lumber. Availability of materials is an issue, and labor shortage. So in spite of the good growth we've had in housing starts this year, it may moderate. We'll get growth in 2021 and 22, but perhaps at a slightly lower rate. Look at our neighbors to the north. Here's Canadian housing starts from 1959 to current. The yellow is the trend line. Pretty flat. They only lost 34.7% of their market versus 3/4 of the market in the States prior to the Great Recession. Here's Canadian housing starts on a monthly basis for the last 3 years, just trending ever so slightly upwards. Big difference between the Canadian and U.S. market is the difference or the relative amount of single-family, multifamily homes. On the left, as it shows the last 3-year average, we've had 70.3% of our homes built in the United States are single family. In Canada, it's the inverse of that. About 71.6 are multifamily. So big difference in the type of structures they're built in Canada versus the United States. Okay, who invented Lincoln Logs? Well, of course, it was John Wright. And you're going to say, so what? Who's John Wright? Well, he happens to be the son of Frank Lloyd Wright, the famous architect, who was falling waters in Pennsylvania. So I guess you could say a tree doesn't fall far. How's that saying? Whatever that saying was. The son of Frank Lloyd Wright. How long did it take to build the Great Wall of China? It wasn't a very fast construction project. It took 2,600 years. That's about 2 miles per year. And it's estimated there were 3.9 billion bricks required to build the Great Wall. Kept a lot. Let's look at the non-residential market now. One way of looking at the market in terms of the size is a consensus estimate done by the AIA, the American Institute of Architects. Twice a year, they put together a consensus estimate. And what this shows are the three major segments: the commercial, the industrial, and the institutional segments of the market. By the way, I know it's a little hard to read, but if you start up here at 77.8, that is office, and then go around on a clockwise basis. It follows the legend down here. So you're going to go around the clock with the legend. You can see there's no one particular dominant segment, a couple larger than others, but nothing really dominates. Retail and other was one of the largest ones, or still is. And 102 there on the left side is education on the larger segments. So that's how the market kind of breaks down. And this measurement, 452 billion in 2020, was the best consensus. Each month, the Census Bureau estimates non-residential construction put in place. And what that means is they try to, during their surveys, how much construction activity is going on in that month. It doesn't mean starts, it doesn't mean completions, it means activity. So for example, if they're building a 20-story hotel, which is not many being built right now, but if you're building a 20-story hotel, and in that particular month, they're doing let's say the curtain wall on the 16th and 17th floors, and they're doing electrical work on the 3rd and 4th floors and plumbing on the 6th floor, or whatever. It measures all that activity. And this is how they report it, is in construction put in place. As you can see, it dipped down after the Great Recession, recovered back in about 2015, and has been slowly growing ever since then. More recently, it's a little discouraging that even before the pandemic, construction put in place started to slide and has continued to slide ever since then. Is onward trend right now. Another way to look at the non-residential market are starts, and Dodge Data Analytics tends to track starts. So these are non-residential starts, which the white line shows that it's been trending pretty well upward on a long-term basis since 2010. But if you look at short-term, it's flat. If you look at just 2007 through the end of 2020, the white line there, the white dotted line, shows the trend has really been down. And how it wound up for the year of 2020 shown here. This shows how during the year, the growth in non-residential starts for each of the last 4 years. You can see 2020 started out about on par with 2019 and prior years, then fell behind during the pandemic, and it wound up about 24% down in 2020 compared to 2019. So the non-residential industry has been hit pretty hard by the pandemic. You can imagine with hotels not being built, office buildings not being built, except maybe in the suburbs where people are now working, or restaurants and so forth, a lot of warehouses and distribution centers, but it's a rough year. It was a rough year for non-residential starts. Another way to look at it is the backlog. The ABC, the Associated Building and Contractors, surveys their members each month and says, how much backlog? How much work do you have remaining to do after you get done with what you're going to do today? And the backlog has been dropping, so there's less work waiting to be done right now in the sector. That's a bit troubling. What's the largest building in the world? Well, apparently it's not the Pentagon. It's the Boeing factory in Everett, Washington. So it's got 472 million cubic feet. It's the largest building, larger than the Pentagon, not because of footprint, because the height is a very volume building, almost a million cubic feet. Is architecture an Olympic sport? No, not right now, but yes, it was from 1912 to 1940. I have no idea how they judged the winners or what the winners were, but it was an Olympic sport. So what are the signals for non-residential construction? Each month, the American Institute of Architects surveys their members as to how are their buildings going. If their buildings are strong, it means you're likely to see work 9 to 12 months down the road materializing out of the work the architects are doing. If their buildings are weak, you won't see as many starts 9 to 12 months down the road. So the building index is derived from that, from the ABI, is derived from the work the architects are doing. As you can see, it's dipped well below 50. So we're expecting to see a downturn in non-residential starts, at least for the next 9 to 12 months. Another group that looks at it is Dodge. They do what they call the Momentum Index, which is a measurement of planning activity for new buildings. It's been going down. Another way to look at it is non-residential construction contracts awarded from the Federal Reserve Bank of Boston. Unfortunately, it is also trending downward over the last several months. Again, like the pandemic paused, but even started before that. So the signals are not real good for non-residential construction for the next year or so. So that leaves us wonder, what is going to happen here? Well, the AIA, the American Institute of Architects, twice a year consults with 8 different experts, including, as you can see, Wells Fargo, to say, what do you think what's going to happen non-residential? And from that, they develop a consensus forecast. And this is the consensus forecast for the next 2 years. Again, the 3 sectors that I showed earlier, commercial will climb, if this is correct, by 7.1% this year, 4.5% for industrial, -4% for institutional, for an overall -5.7%. But if the forecasts are correct, rebounding next year, not extremely strong growth, but growth nonetheless. So it could be a little rough year for non-residential. Look at Canada. These are Canadian non-residential permits from January 2011. Last year, again, trending upward again, affected by the up over a long period of time. If you go way back to the beginning of the presentation, I said the Great Recession is an oxymoron. Here's a couple of visual oxymorons to ponder while I tell you what I'm going to do next. What I'm going to try to do is kind of give you the high points for what we've discussed for the last 57 minutes by the 3 segments, and that is the general economy. It's very much a mixed bag. We show there's an alphabet soup going on. There's some B's, there's some W's, there's some U's, it's not consistent. Consumer spending is vital. We account for 70% of the economic growth, so we've got to be able to get out of our houses and spend some money on vacations and all the other things in order for the economy to improve, which is all dependent on the pandemic. So the employment situation must improve. So the general economy is doing okay, but a lot of room for improvement. And hopefully, as the pandemic eases, we'll see the improvement that's so necessary. From a residential standpoint, single-family growth is expected to continue, maybe at a slightly reduced rate. Multifamily is stable. There is enough demand, as we showed about the demographics. We really should be building 1.4 million homes per year. Most of the conditions are favorable, low interest rates, low inventory. Yes, there are some concerns. Will I have a job? Or interest rates are going to go up. And lastly, non-residential. There were some signs of trouble pre-COVID that are slowing. It's been hurt badly by the pandemics, particularly certain segments. Some fundamental shifts, as we work from home, when offices relocate and so forth. There's actually a long-term fundamental shifts. Unfortunately, if the forecasts are correct, not be a growth year, but better times are ahead. So that wraps up. Let me give thanks to PPFA for allowing me to do this, and appreciate the opportunity to talk to you. And then give special thanks also to Uponor. I still have a consulting relationship with Uponor, and they gave me permission to make this presentation. Now, let me end up with one thing: is tomorrow morning or tomorrow, as you're sitting in front of your computer screens in your sweat clothes or your workout clothes or your pajamas or shorts and a t-shirt, whatever you now have for your normal business attire, just remember one thing. Tomorrow is National Fun Ed. So again, I appreciate the opportunity to spend this time with you, and hopefully I'll give you some information that will be helpful.
Dale, thank you very much. We do have actually a couple questions, if you don't mind fielding a few.
Sure.
Okay, great. And I'm going back in your presentation with these. I didn't want to interrupt your flow. First question is, can the Dow Jones Industrial Index be trusted if there is in fact a bubble in the stock market?
I'll let Wells Fargo be the expert on this, but one of the things that I read recently, one of the reasons it's accelerated the way it has, is because in spite of the unemployment issue, in spite of a lot of people in real dire times right now, the overall economy is such that we're spending more. I'm sorry, making more and spending less as a total economy, to the tune of about $1.6 trillion in the period January through November of 2020 versus the same period in 2019. There is a net change of about $1.6 trillion. Some of that increase of income in that regard was due to the stimulus. Can we trust the DJIA? I'm guessing there'll be a correction. It's probably overblown a little bit. I don't think there'll be a severe drop. I say it'll be interesting again what the gentleman from Wells Fargo has to say.
Absolutely. Thank you. And then will COVID stimulus relief packages create a drag on the economy by ballooning government debt? Probably another Wells Fargo.
Yeah, although I was listening to a webcast yesterday by Vazanda. Each month they do a webcast. And their take on it is, yes, the debt is considerable, higher than it's ever been, higher than we want it to be. But the downside of not doing that is more severe. Yes, something has to be done to arrest that debt and bring it down. But the effect of not doing it considerably outweighs the dilemma of doing it. Again, but something long-term has to be done about that debt.
Absolutely. Well, thank you. I don't think we have any additional questions right now. I do want to remind everyone that we will be distributing a recording of this presentation through our current news in the next day or so. So keep an eye out for that. And once again, Dale, thank you so much. Great to hear from you. Great information.
Thank you.
Have a great day, everyone.
Bye now.
Bye-bye. Thank you.